What if you could learn the exact investing principles that inspired Warren Buffett, one of the richest men in the world? That's exactly what The Intelligent Investor by Benjamin Graham delivers. First published in 1949, this book remains the ultimate guide to safe, disciplined, and profitable investing. But here's the twist: Graham doesn't tell you how to get rich overnight. Instead, he teaches you how to avoid stupidity, stay patient, and let wealth grow over time. Let's break down the timeless lessons of the intelligent investor. 1. The difference between investing and speculating. Graham starts with a warning: most people think they're investing, but they're really speculating. Investors focus on long-term safety and steady returns. Speculators chase quick profits, gamble on trends, and react emotionally. Lesson: don't try to predict short-term market moves. Instead, build wealth by thinking like an owner, not a gambler. 2. Mr. Market, the most famous metaphor in finance. Imagine you have a business partner named Mr. Market. Every day, he offers to buy your shares or sell you his at different prices. Some days he's optimistic and offers high prices. Other days he's depressed and offers dirt cheap prices. Most people let Mr. Market's mood swings control them. Graham says the intelligent investor uses him instead. Lesson: don't follow the market, take advantage of it. Buy when prices are low, sell when they're high, but only if it makes sense long term. 3. Margin of safety, the golden rule of investing. This is Graham's most powerful principle. A margin of safety means only buy an investment when it's priced well below its real value. This cushion protects you if your analysis is wrong or the market crashes. Example: if a stock is worth $100 but you only buy it at $70, you have a built-in safety net. Lesson: never pay full price for an investment. Always demand a margin of safety. 4. Defensive versus enterprising investor. Graham divides investors into two types. Defensive investor wants a simple, safe, low-effort strategy. Focuses on index funds, bonds, and diversification. Avoids risk and emotional decisions. Enterprising investor, willing to put in more work and research. Studies companies deeply. Buys undervalued stocks, small caps, or special opportunities. Lesson: know yourself. Are you defensive or enterprising? Your personality should match your strategy. 5. The importance of discipline and patience. The stock market will test your emotions. Fear and greed cause most investors to fail. Fear makes people sell during crashes. Greed makes people buy during bubbles. The intelligent investor stays calm, disciplined, and focused on long-term value. Lesson: investing is not about IQ, it's about emotional control. 6. Stocks versus bonds, the balance. Graham recommends balancing between stocks and bonds depending on your risk tolerance and market conditions. A conservative split is 50% stocks and 50% bonds. Adjust slightly depending on opportunities, but don't swing wildly. Lesson: balance keeps you safe from both inflation and crashes. 7. The danger of market predictions and gurus. Graham warns against listening to so-called experts. No one can consistently predict short-term market moves. Analysts, TV pundits, and newsletters often cause more harm than good. Lesson: trust principles, not predictions. 8. Inflation, the silent wealth killer. Even safe investments like cash can lose value because of inflation. Bonds can be eaten away by rising prices. Stocks, when chosen carefully, can protect you from inflation long-term. Lesson: avoid being overly conservative. Safety can also be risky if inflation erodes your wealth. 9. The role of research and analysis. Graham emphasizes the need for fundamental analysis. Look at earnings, assets, and long-term performance. Don't be distracted by hype, rumors, or short-term movements. Lesson: buy businesses, not tickers. 10. Key habits of the intelligent investor. Let's sum up Graham's timeless habits. Think long-term, don't get distracted by daily noise. Demand a margin of safety, protect yourself from losses. Stay disciplined, don't let fear or greed control you. Choose your strategy, defensive or enterprising, and stick to it. Diversify, don't put all your money in one basket. Be patient, wealth grows slowly, but surely. The big takeaway. The intelligent investor isn't about beating the market or finding the hottest stock. It's about avoiding big mistakes, protecting yourself, and letting wealth grow through discipline and patience. As Warren Buffett, Graham's most famous student, said, "The best investment you can make is in yourself. But the second best is following Benjamin Graham's principles." So, are you more of a defensive investor, focusing on safety? Or an enterprising investor, willing to dig deep for opportunities? Drop a comment below and let's see where you fit. If this breakdown of the intelligent investor gave you clarity, hit the like button, subscribe for more book wisdom, and share this video with someone who wants to learn investing the smart way.